Hello everyone and welcome back. This video has been long awaited. Today, as you can see by the title of this video, we will be discussing turtle soups and how to actually trade them. For a long time there has been trading influencers, speaking about turtle soups, how successful they are at trading turtle soups. However, for the most part, these very influencers do not actually give you the model or strategy or knowledge to actually execute turtle soups. This lecture alone is all you will ever need. I'm going to repeat this. This is all you will ever need in your entire life to trade turtle soups successfully and consistently. I will be going over how to enter a turtle soup, where to put your stop loss on a turtle soup, how to take profits on a turtle soup, and the different high probability models that there are for trading turtle soups. This is going to be a long one. Take your time. Allow your brain to absorb the knowledge and information being given. Study and backtest. Without wasting any more of your time, let's get into this. So what is turtle soup? Right before we get into the knowledge, right before we get into the wisdom, we want to learn where this strategy came from. Who invented it? Was it ICT? Was it Romeo? Was it Wyckoff? Unfortunately, it was none of those people. Many of you probably know the book Street Smarts. This book was written by two authors, specifically Lawrence A. Connors and Linda Bradford. The turtle soup is a trading model or strategy that has been popularized by Romeo, not created or invented. It has simply been popularized. He is not the creator, and he is not the first person to teach it. ICT mentions turtle soups in some of his lectures. However, he never truly goes in depth. I wonder why. There's a reason why ICT and other influencers such as Romeo do not truly go to the depths when talking or teaching about turtle soups. Because it is the last key needed to dominate these markets. Turtle soup was first talked about in 1996 by Lawrence A. Connors and Linda Bradford Raschke. These are the authors of Street Smarts. The book teaches how to actually trade turtle soup using the 20, 40, and 60 IPTA ranges. These specific ranges will help you find the correct turtle soups, the most high probability turtle soups. We will discuss this later on in the presentation. Do you need this book in order to succeed? The answer is no. This lecture is all you will ever need. However, learning directly from the source is not a bad idea. So if you want to order the book, go ahead, your call. Some examples of turtle soups for the new ones who have never seen it. Wick below an old low, turtle soup. Your entry is here. Long. Wick below an old high. Your entry is here. Turtle soup. So these are two very basic examples about or of turtle soups. The fundamentals. There are a few rules that you need to keep in mind. Write this down. Buy the lows and sell the highs. You must only buy the lows and sell the highs, or do not buy the highs and do not sell the lows. To find out whether price is high or low, 4 things can be utilized. These 4 things, you can categorize them as measuring a high and a low, measuring a range. Tool number 1, the 20, 40, and 60 IPTA ranges. Tool number 2, using the Fibonacci and a dealing range. Tool number 3, using the Fibonacci plus the current expansion leg, the current range. Tool number 4, understanding the higher time frame open high low close or open low high close. There was an error here. This is OHLC and OLHC. Open high low close, open low high close. So what is this IPTA data range that I've been mentioning? Well, 20, 40, and 60 represent the amount of days. Days of what? Not to worry, we will dive into it. IPTA stands for Interbank Price Delivery Algorithm. The IPTA was introduced to the markets. This is going to be something new. Talking about history, the IPTA data ranges have been added to the markets in the late 1990s. This is when the markets turned from the normal market makers, which were people, to the algorithmic market makers, which can be considered as IPTA. There are many algorithms. IPTA is one of them, introduced in the late 1990s. IPTA is very important when determining the directional bias of the markets. This is needed to understand how price truly moves. ICT teaches this throughout the core content. So if you would like, go ahead, pause this video, and go watch ICT's core content. IPTA moves prices to areas where new liquidity rests. The algorithm is constantly seeking new liquidity zones, and every 20 days, price will be pushed to 1. 20, 40, 60. These are multiples of 60. Sorry, 20. IPTA works by looking back at historical price over the last 20, 40, and 60 trading days. It uses this historical data to identify the areas of liquidity. These areas are often referred to as PD arrays. What are PD arrays? These are your SIBIs, BISIs, breakers, order blocks, rejection blocks, etc. So how do we measure the IPTA data range? Go back 20 candlesticks, 20 days on a daily chart, and find the 20-day high and low. Keep in mind that the weekends count as days. Do not forget that. Every 20 days, there will be a turtle soup, give or take 1 to 3 days. That right here is very important. Every 20 days, give or take 1 or 3, there will be a turtle soup, a high probability turtle soup. If price moves below a 20-day low, the 20-day IPTA range, that is enough for you to become bullish or at least to not be bearish. Is price at the high or low of the 20, 40, 60 IPTA data range relative to the premium/discount? What does this mean? This is basically asking, are we in a premium or discount market? Are we at the lower end of the 20-day range or the higher end of the 20-day range? If we are in a premium, meaning above the 50% of the 20-day range, you do not want to be bullish, you want to be bearish. And if we are below the 50% in a discount market, you want to be bullish, not bearish. Let's take a look at a quick example. This represents the last 20 days IPTA 20-day data range. This is the IPTA 40-day data range, and this is the 60. Relative to the 60-day data range, are we at a low or high? Premium discount, where are we? We are at a discount below this line. How about the 40-day? Premium discount. The shaded area is the premium. Up here below this line is the discount. Where are we? We are in a discount market. Relative to the 20-day data range, are we in a premium or discount? High to low. We are in a discount below the EQ of the range. If we listen to what I explained in the previous slide, would you be bearish or bullish? Pause the video, look at the chart, and have your answer ready. The answer is bullish. Why? Because we are below the 60-day equilibrium, we are below the 40-day equilibrium, and we are below the 20-day equilibrium. That means that the market is in a heavily discounted market. This in itself is enough to be bullish or to at least not be bearish. Let's talk about using the Fibonacci and the dealing range. A dealing range refers to a specific price range within the market. Unlike the IPTA data range, the DR is a price range. The IPTA data range, for those of you who don't know, is a timed range. Every 20 days there is a range, regardless of price. That is a timed range. The dealing range, on the other hand, is a price range based on price, swing highs and swing lows. This range is defined by key price levels such as recent swing highs and swing lows, and is basically used to anticipate potential market movements, i.e. determining bias. A dealing range is defined by selecting a significant swing low and high. This range helps traders understand whether price is in a premium or discount market, the same way that you look for a premium and discount market using the IPTA, you do the same thing for the dealing range. So how do we do this? Measure the dealing range with a fib. Go to the swing high or low. In this scenario, we are talking about a low that broke a high or a swing high that broke a low. Then extend the fib to the opposing end of the range. The 0.5 level on the fib represents the equilibrium of the dealing range. In a bullish market, you want to be entering when price is in a discount, below the 0.5 level. In a bearish market, you want to be entering when price is in a premium above the 0.5 level. Remember the first rule that I mentioned. Buy low and sell high. You want to buy in a discount market and sell in a premium market. Taking a look at this dealing range as an example, from the low to the high, Fibonacci 0.5, is price below or above the equilibrium of the dealing range? Price is below. This is the 0.5 level. We are below. What does that mean? This means we are in a discount market. That means you want to be bullish, or at least not bearish. Just to let you guys know, this example is the same example as the IPTA data range. So we will be applying all the concepts together in correlation to help you understand better. Swing high to swing low. Which high and low? Well, first off, we use this low Y. The low that broke the high. Close above the high, breaking through it. Swing low, swing high. Using the Fibonacci with the current expansion leg. An expansion leg in trading is when the market exits a consolidation phase and makes a significant rapid move, either up or down, depending on the market conditions and breakout direction. In simple terms, an expansion leg is a quick, very fast price movement either up or down. Price moves from consolidation to expansion, always. That means price will consolidate, expand, consolidate, expand, consolidate, expand. Note that the manipulation and retracement are a part of the consolidation phase. This is important to understand if you are ever getting confused. We consolidate, manipulate within the consolidation leg, expand, retrace within the consolidation leg, and expand again. Example. Imagine if the market trades in a narrow range for several days. Suddenly it breaks out and moves sharply upwards. This sharp move is the expansion leg. So how do we use it? How to use the expansion leg to measure the high or low? Visually speaking, where is price? Looking at your chart, where is the price? Is price low or high relative to the most current, most recent expansion leg? So let's take a look at this example right here. Where is price relative to this expansion leg? Are we high or low? Clearly, visually speaking, price is low. You can use a Fibonacci to help you determine whether we are in a premium or discount. However, in this example, it is quite obvious. Price is low. We should be bullish and not bearish. So in this case, we are low in all three aspects. You should be looking for buys. The fibs are pulled from the most energetic swing that broke another swing. So you must understand that all three aspects, the IPTA data range, the dealing range, and the expansion leg, using all three in conjunction, we are all bullish, using all three concepts. That is amazing when looking for a bullish turtle soup. What does this mean? This means you are bullish and not bearish. Just to refresh your minds, price consolidates, turtle soups expands, consolidates, turtle soups expands, consolidates, turtle soup expand. This is how price functions. What is an expansion? Breaking through a high that rejected a low. Breaking through a high that rejected a low. Breaking through a high that rejected a low. I am repeating this because it is important. This is consolidation, a range, and this right here is expansion. Higher time frame, lower time frame. Higher time frame. Price consolidates, manipulates below a low, expands upwards. Failure, swing low into what? An order block. Turtle souping an recent low, expanding higher. Let's use the higher time frame, open, low, high, and close, or open, high, low, and close. The concept is based around the power of three, or as some people call it, accumulation, manipulation, distribution. You should be surfing the higher time frames to see whether price is below or above the open of a specific higher time frame candle. If price opens and consolidates, then manipulates lower, below the open, turtle souping a low, this is enough for you to turn bullish considering the dealing range and the IPTA data range. This means when you use the dealing range and IPTA data range, draw out the higher time frame open of a specific candle, and if price consolidates at the open, manipulates below an old low, and the IPTA and DR dealing range are both telling you we are bullish, you enter that turtle soup. When bullish, your goal is to enter below the open of a higher time frame candle. When bearish, your goal is to enter above the open of a higher time frame candle. These 2 points are very important and will save you thousands of dollars. Let's take a look at an example. This line right here represents the open of the higher time frame candle. Everything above is overbought, everything below is oversold. This goes back to the very basics of the open, high, low, and close. This means that buying above major highs is a bad idea, while selling below major lows is also a bad idea. Write this down. Selling a discount PD array is a bad idea, and buying a premium PD array is a bad idea. You do not want to be buying bullish fair value gaps, bullish PD arrays in a premium market. Vice versa, when bearish, you do not want to be buying discount PD arrays, discount fair value gaps, bearish fair value gaps in a discount market. Write that down and keep it next to you the next time you are trying to place a trade. So if we are bullish, you want to be entering below the open. If we are bearish, you want to be entering above the open. Use the IPTA data ranges to help you scan the markets and determine whether you are bullish or bearish. Combining all the concepts, all 4 tools. If the expansion leg is down, we will then use the IPTA data range and dealing range to verify the bullish thesis, as the rule is to never sell a low and never buy a high. We want to buy the low instead. If the data range and the dealing range and the expansion leg are all saying price is low, then it is time to become bullish. as we want to buy when all the ranges are low together. Important, very important. All you need is 3 of the 4 concepts to be lining up. For what? Basically, you need 3 of the 4 concepts to line up in order to accurately and consistently measure a high and low. What is measuring a high and low? That means you are determining bias. Most people don't tell you how to determine real bias. This is exactly how. Here's a little nugget for everyone watching. The 20-day range and the 20-day range and the 3-day range is enough to give you a nice short-term trade. Let's talk about time, as time is the most important concept when trying to trade turtle soups, or trade in general. Time over price. Time is always seen through the lens of open high, low, and close, or open low, high, and close. 2 of which are fixed. You have the opening time and the closing time. Your job is to catch a high or a low. That is the turtle soup. You don't need to catch the extremities. Here is a little tip. Write this down. The midpoint of the candle's time can also be used as a fixed value to exit trades in case you expect an expansion and get an accumulation. This means if you are expecting an expansion leg and instead price is consolidating, this gives you a chance to exit the position. If price reverses on you, it tends to happen once 50% of the candle's time has passed. Write that down. Price levels are of no use until time is considered. Time is no use until price is at a key level. Guys, everything I am saying right here is very important. This, of course, is a classic high time frame sell candle on the lower time frame. This right here. However, it can come in many shapes and sizes. Turtle soup a high, expand lower. Turtle soup, consolidate, consolidate, manipulate, enter trade, turtle soup, short. In the next slides, all 6 types of candle formations will be shown. Pay close attention to how we behave at the open, high, low, and close, or the open, low, high, and close values and time. Pay close attention. This right here is a classic sell candle. Exactly like this one right here. Price opens, bearish candle, the open is here, close is here, low and high. So open, high, low, and close. Open, high, low, and close. Your job is to catch the turtle soup or the turtle soup. You do not trade any of this. Now, if you have missed the turtle soup entry, there are ways to enter below. That will be discussed later on. A classic buy candle. This is exactly like the sell candle, however, instead of being bearish, we are bullish. So price opens right here, forms a low, forms a high, and then closes. Open, manipulate lower, below the open, buy the turtle soup, expand higher, high, and close. Open, low, high, close. Open, consolidate, manipulate, expand. Retrace, expand. On a classic sell candle, we rally above the open when bearish to then drop. As we can see, we rally above the open to then drop. Vice versa, on a buy candle, we drop below the open when bullish to then rally. Drop below the open to then rally. Candlestick number 3, the third type of candlestick formation, consolidation or range on a sell candle. This is also called a doji. Price opens, forms a high, forms a low, and closes around the midpoint of the range. These candles right here tend to form reversals. It's the same thing with the the buy candle. Price opens, turtle souping a high. So open, consolidate, manipulate, turtle soup, expand lower. The opposite on the buy candle. Open, consolidate, manipulate, turtle soup, buy the low, below the open, expand higher. High and close. Open, low, high, close. Let me repeat the sequence. Open, consolidate, manipulate below the low, below the open, buy, expand higher. These usually form after large range candles, sometimes even before anticipating a large candle. These ranging candles can later on be used in a range model to trade the extremities. We'll learn this later on in this lecture. For now, we'll keep on learning about the different candlesticks. Candlestick number 5, the bearish reversal candle. On the higher time frame, price opens, manipulates higher, and distributes lower. Open, high, low, and close. So we open, we consolidate, break through a high, break through a high, break through a high, ultimately forming a turtle soup at this high right here. Entry, short, and then we form the low and close. Same thing for the bullish reversal candle. Price opens, manipulates lower, and expands higher. Open, consolidate, manipulate, and expand. These can be used to anticipate reversals and rejections on a higher time frame. Usually price reverses at around 50% of the candle's printing time. I mentioned this before. Price usually tends to reverse when 50% of the candle's time has passed. This means on an hourly chart, when 30 minutes has passed, price tends to reverse. Time is fractal, so this very rule can be applied to any time frame. Let's talk about how price can react to different key levels. There are 3 ways, and only 3. Number 1 is a V-shaped reversal. This is when price taps the level and expands up quickly. Number 2, the most often occurrence of a reaction would be number 2, the W or M shape reversal. This usually creates a turtle soup or equal lows or equal highs. And number 3 is the range. This is of course the least favorable. This happens when the key level is touched multiple times. You'll understand that a key level is usually tapped not once but twice. That is why the W or M shape reversal is most often used. Knowing when manipulation will likely occur will help you time your turtle soups. When entering based on the yearly profile, you look for turtle soups in April to July, below the open when bullish and above when bearish. Use the monthly or weekly chart to map out. When entering based on the monthly profile, you look for turtle soups in week 2. Why? That is the manipulation. Below the open when bullish and above when bearish. Use the daily or 4-hour to map it out. When entering based on the weekly profile, you look for turtle soups on Tuesday, 70% of the time. Below the open when bullish and above when bearish. Use the 2-hour or 1-hour time frame to map it out. I want to talk about this for a second. Turtle soups or lows and highs of the week form on Tuesdays 70% of the time. That means that 7 times on 10, the weekly low or high will form on Tuesday. Look for that turtle soup. When entering based on the daily profile, you look for turtle soups in London kill zone between 1 a.m. and 5 a.m. New York time. The sweet spot, as I have mentioned in my previous video, the London twilight zone between 3 a.m. and 5 a.m. This is for a classic buy or sell day with a New York session reversal profile. Turtle soups can also be looked for in New York's kill zone. The sweet spot is 9 a.m. to 1 p.m. The best time frame for this is the 5-minute or 15-minute. It is always a 3-candle formation play. Those of you who have watched CRT understand this. Candle 1 offers a range, which is then souped in candle 2. Candle 3 uses candle 2's manipulation of candle 1 to target candle 1's opposing end of the range. If you don't understand what I just said, go ahead and watch my CRT video. The same premise can be used intraday for 4-hour candles. The daily candle is divided into 6 4-hour candles, 1, 5, and 9. This is specifically for Forex. For futures, it is 2, 6, 10. The opening times of the 4-hour candle for Forex is 159, and the opening times for futures on the 4-hour candles is 2, 6, and 10. Use the 5-minute to map this out. Just like with the other profiles, you mark the open of the 4-hour candles using the times above. Every manipulation buy should be below the open and every manipulation sell should be above the open. I am repeating myself many times throughout this video because it is important for you to understand. To narrow things down, within the 9 a.m. 4-hour candle on Forex, there are sweet spots to catch the power of 3 or accumulation, manipulation, distribution, and specifically to time turtle soups. Those of you following me on Twitter already know that between 9 a.m. to 9:30 is accumulation, 9:30 to 10 is manipulation, and 10 to 10:30 is the distribution, plus or minus 5 to 10 minutes. This is exactly why the 4-hour candle can be perfectly timed through the lens of its opening price at 9 a.m. Buy below when bullish and sell above when bearish. You do not want to sell below a low, and you do not want to buy above a high. The 90-minute time frame in general is quite interesting. Try to apply it to your charts and study it. That is the most I will say about the 90-minute time frame. However, it is up to you to find more. So here is an example of 9 a.m. 9 a.m.'s open, 9 to 9:30, 9:30 to 10, and 10 to 10:30. 9 a.m. open. Turtle souping a high when during the manipulation phase of the 9 a.m. candle. Consolidate, accumulate, manipulate above a high, and distribute lower. This is the play. Relative to the higher time frame candle, are we above or below the open? We are above. That means we want to sell. Relative to AMD or the power of 3, are we in the manipulation, distribution, or accumulation leg? Manipulation. What are we manipulating? The high. Short, targeting the low. Here are some keys. There are 10 high probability day trades per week. Write all of this down. Very, very important. This will lead you to success. So, there are 10 high probability day trades per week. Once every 1 a.m. candle and once every 9 a.m. candle. 2 per day, 5 days per week. There are 25 good quality trades per week at 1 a.m., 5 a.m., 9 a.m., 1 p.m., 5 p.m., and 9 p.m. Keep in mind, 9 p.m. will usually just consolidate. So for now, stay away from 9 p.m. Please do keep in mind, this is Forex specific. For futures, it would be 2 a.m., 5 a.m., and 10 a.m., 2 p.m., 5 p.m., 2 p.m., 6 p.m., and 10 p.m. 2610 for futures, 159 for Forex. Likewise, there are 2 high probability short-term trades per week. Once at the low of the week and once at the high of the week. The first wick will usually form on Monday to Wednesday. This is a key right here. Wednesday will not form the high and the low of the week. there is a very, very, very low chance that Wednesday will form a high and low of the week. Trade number 1, the opposing range will be capped on Thursday and or Friday. That is trade number 2. So just to clarify this, from Monday to Wednesday would be trade number 1 for the short-term trade. And Thursday and Friday will be trade number 2. You want to catch the turtle soup at the high of the week, and you want to catch the turtle soup at the low of the week. Vice versa when bullish. To know which of these days exactly is the high or low, price needs to be considered. Is price at a key level? That is the question you need to be asking yourself. Let's talk more on manipulation. Expect manipulation between these times: 2 a.m. to 3 a.m., 9:30 a.m. to 10 a.m., and 1:30 p.m. to 2 p.m. Best utilized with a 4-hour or daily profile. If you are still unsure of the 4-hour and daily profile, please rewind this video and start at the beginning. Trading models. Let's talk about the range model. Time is fractal. That means this will work on all time frames. Step 1. Identify the higher time frame bias and narrative. Step 2. Identify the key levels above or below the range. Step 3. Wait for price to take one side of the range into the key level at a manipulation time. Keep in mind the higher time frame opening price of the candle. Step 4. Enter with a limit at one side of the range or the higher time frame PD array. Step 5. Target 1 is the swing that purged one of the sides. In this example, it would be the high that caused the turtle soup. Target 1 is the equilibrium 50% of the range, and target 2 is the opposing end of the range. Your stop loss can be placed in 4 different ways. So let's take a look at this example. We have our range low and our range high. We have our higher time frame candle open. Price is below the candle's open. We drew out the manipulation time using a vertical line. Price manipulates at the exact time that we expect it to, below a low, the range low, into a higher time frame key level, which is a PD array. So key level, range low, below the higher time frame open, and below the EQ of the range. So we are in a discount market. We are hitting a key level, which is this PD array right here, and we are at the low of the range. Manipulation time hits. We enter the trade long, TP.1 at the high that caused the turtle soup, or at the equilibrium. And TP2 ultimately would be the range high. how to place your stop loss. Number one, you can place it, in this example, it would be the low of the higher time frame PD array. If you are bearish, it would be at the high of the higher time frame PD array. This is likely going to be your most secure stop loss. You enter the trade at the key level, your stop loss at the low of the PD array, where you're targeting the 50% and then the opposing end. Stop loss number two, you can use an intermediate term high or intermediate term low that you trust as your stop loss to the left. So we see an intermediate term low right here. Instead of using the low of the PD array, you recognize the intermediate term low and understand that price shall not breach this low if price needs to go higher. Put your stop loss at this low. Enter the trade at the key level, range low, manipulation time below the higher time frames open. Going long, targeting the equilibrium and then the opposing end of the range. You need to study this. Study intermediate term highs and lows. Stop loss placement number three, a lower time frame change in state of delivery. What is the change in state of delivery? The order block creation. Price wicks below, hitting the key level. We reverse up, turtle souping this low right here. Breaking this bearish candle, red candlestick. As soon as we close above this specific candle, the order block is created and the change in state of delivery is created as well. Enter at the close, stop loss at the swing low right here that caused the change in state of delivery, targeting the equilibrium and then the opposing end of the range. Stop loss number four. This is a blind stop loss with a 1 to 3 risk to reward. Enter the trade, measure your take profits, and then adjust your stop loss to win. Adjust it so that your R to R is 1 to 3. Not 1 to 2, not 1 to 1, 1 to 3. If you are using this stop loss, I do not recommend it. However, if you are confident, you can go ahead and use it. When to anticipate ranges. Regarding price, ranges can be anticipated when 1. We formed a large range candle recently, or we anticipate a large range candle forming soon. Number 2, we are above the open of a higher time frame candle when bearish. Vice versa, we are below the open of a higher time frame candle when bullish. Number 3, we have SMTs on both sides. What does this mean? We have SMTs at the high and SMTs at the low of a range. Number 4, we are stuck in between two PD arrays on a higher time frame. This means there is a SIBI below us and a BISI above us. Number 5, we start rejecting highs and lows. This was mentioned in my CRT masterclass. When price is rejecting highs and lows, this is how you define a range. Remember, buy low and sell high. Buy the range low and sell the range high. 2. Never buy the range high and never sell the range low. Only if a new PD array is formed and we have multiple strong closes above or below a range, best paired with SMT, that is the only time you should be looking to enter, as that is likely to be the real breakout. Never trade within the 50%, or as we call it, the equilibrium of the range. Number 4, the first purge of a rally is usually a turtle soup. That is the false breakout. Number 5, the first hit of a key level is usually a false move. Most of the time, price hits the same key level again for a turtle soup. I mentioned this at the start of the video. A key level is usually tapped twice. That is what forms a W or M shape reversal. Write that down. Number 6, if you miss the entry, a pyramid or a re-entry can be taken on the retest of one side of the range after the purge. All of this is important. Study it. This concludes part 1 of the Turtle Soup Masterclass. I was going to release this entire lecture in one part until I recorded everything and realized that the lecture would have been 2 hours long. It is not worth it for me and for you if I were to release the entire masterclass in one go. You guys are better off learning slowly, step by step, exactly how to trade, rather than trying to stuff your brain with so much information that you end up losing it. Allow your brain the time to absorb the info. Part 2 will be uploaded on Sunday. With that being said, study everything that you have learned so far, and good luck trading.